Welcome to our weekly analysis for the USD/CHF pair, brought to you by FX Tech. This is our report for the week of December 1st to 5th, 2025. In this video, we'll break down a week of consolidation where the market was caught between two powerful forces: surging expectations for a Federal Reserve rate cut and the ever-present threat of Swiss National Bank intervention. We'll examine the key news events that shaped price action, dive deep into the technical consensus from 5 leading sources, and lay out the critical support and resistance levels you need to watch. Finally, we'll provide actionable short-term and mid-term outlooks, complete with trading strategies for both trend and range traders. Stay tuned for a comprehensive breakdown of where USD/CHF might be headed next. Taking a look at the market overview, the USD/CHF pair was essentially trapped in a tug-of-war. It closed the week with a minor gain of 0.14% at 0.8046, but this small change hides the underlying volatility. The pair tested the lower boundary of its recent range near 0.7990 early in the week, only to rally back to a high of 0.8055 by Friday. This price action confirms that the pair remains locked in its multi-month consolidation zone between 0.7900 and 0.8100. The key takeaway is that neither the bears, fueled by Fed rate cut talk, nor the bulls, supported by the SNB, could land a decisive blow. The market ended the week with a slight bullish bias, but the range is still king. One of the biggest stories driving the market this week was the dramatic shift in Fed expectations. The probability of a 25 basis point rate cut at the December 9th to 10th FOMC meeting skyrocketed to 87%. This rapid repricing sent shockwaves through the dollar, triggering a swift sell-off and contributing to USD/CHF's 1.4% decline from its November highs. While most analysts believe a cut is now fully priced in, this doesn't eliminate risk. The real market mover will be the Fed's forward guidance and the infamous dot plot. Any deviation from expectations could ignite significant volatility. For now, the high probability of a rate cut is acting as a major headwind for the US dollar. Counterbalancing the Fed's dovish tilt is the formidable Swiss National Bank. The SNB has once again expressed concerns about excessive franc strength, which harms their export-driven economy. The market has taken note. With a long history of rapid and decisive currency intervention, the SNB has effectively created a psychological floor for USD/CHF around the 0.7900 level. This perception encourages traders to buy on dips, knowing the central bank is likely to step in if the franc appreciates too quickly. This SNB put provides a powerful backstop for the pair, limiting downside risk and creating an asymmetric trading environment where the path of least resistance may eventually be to the upside. Just when the bears thought they had control, a positive data release from the US shifted the momentum. On Friday, the University of Michigan Consumer Sentiment Index came in better than expected, providing a much-needed boost to the dollar. This catalyst was strong enough to push USD/CHF above its 200-hour moving average for the first time all week, a key technical signal. The pair rallied to a weekly high of 0.8055, demonstrating that the US dollar still has resilience, even in the face of high rate cut expectations. This late-week strength tilted the short-term bias to the upside and set a more bullish tone heading into the weekend. When we look at the technical consensus from 5 major analytical sources, a clear picture emerges: consolidation. TradingView notes a neutral stance, while Investing Live highlights the bullish break above the 200-hour moving average. Action Forex and Forex.com both emphasize that the pair is locked in a corrective pattern or a multi-month range, awaiting a catalyst. Finally, Daily Forex points to a potential rounded bottom formation, favoring a buy-on-dip strategy. The overwhelming consensus is that while short-term bias may fluctuate, the pair remains range-bound until a significant driver, like a central bank decision, forces a breakout. This alignment across sources gives us high confidence in the current market structure. To trade this market effectively, you must know the critical levels. The ceiling, or resistance, is firmly established between 0.8103 and 0.8153. This zone has capped rallies for 5 months. A breakout requires a move above the 0.8052 level to even signal intent. On the downside, the floor is multi-layered. The 0.8000 mark serves as immediate psychological support. Below that, the weekly low of 0.7990 is the next test. But the most critical support is the 0.7900 level, the major floor widely believed to be defended by the Swiss National Bank. These levels define the battlefield for the coming weeks. A break of either the ceiling or the floor will signal the next major trend. For the next 1 to 2 weeks, our outlook is neutral to slightly bullish, with a 60% probability assigned to the bullish scenario. Following the break above the 200-hour moving average, the path of least resistance is a test of the upper resistance zone between 0.8076 and 0.8123. This would be driven by continued US data strength or pre-Fed positioning. The bearish scenario, with a 40% probability, would see the pair fail to hold above 0.8040 and fall back to test the 0.8000 psychological level. Ultimately, the Fed's decision on December 10th will be the decisive event that either validates the bullish momentum or sends the pair back to the bottom of its range. Looking out over the next 1 to 3 months, the key level to watch is 0.8153. We assign a 55% probability to a bullish breakout scenario. If we see a decisive weekly close above this level, it would confirm the rounded bottom formation and could unleash a significant trend reversal, targeting the major resistance zone between 0.8350 and 0.8416. The alternative, with a 45% probability, is that the central bank meetings fail to provide a clear catalyst, and the pair continues to chop within the frustrating 0.7900 to 0.8100 range, a pattern that could extend well into the first quarter of 2026. The entire midterm outlook hinges on breaking that 0.8153 ceiling. Finally, let's talk strategy. For trend traders with a cautiously bullish bias, look to buy on dips towards the 0.8025 to 0.8040 area, with a stop loss just below 0.8000 and targets at 0.8076 and 0.8103. For range traders, the strategy is clear. Sell near the top of the range around 0.8100 and buy near the bottom around 0.7920, with stops placed just outside these boundaries. Most importantly, with major central bank meetings ahead, risk management is paramount. Reduce your position sizes to account for potential volatility and never risk more than 2% of your capital on a single trade. Stay disciplined and monitor the news flow closely. That's all for this week's report from FX Tech.